ready? Yes, sir. Good morning. We are Team George Creative. We will be talking on Z Entertainment Enterprise Limited. So what are the three main factors you look for to arrive at an investment decision in equity? Its current business, its future prospects, and its valuation. Z has a great business, an exciting future, but valuations are a tad too stretched. It's the classic example of the good company syndrome. Based on our analysis, we recommend a sell rating and arrive at a target price of 220, indicating a potential downside of 16%. So now let's have a look at why the future for Z is so exciting. The global broadcasting industry is expected to clock a growth rate of 5% till FY17, whereas the Indian broadcasting industry is expected to grow at 19%, mainly fueled by digitization. This exceptional growth will be driven by the fact that pay TV ARPU, TV penetration rate and TV viewing time in India is very low compared to other countries in the world and will eventually converge to global averages. Emerging trends in this sector are all set to unlock new opportunities for broadcasters. Among these, digitization will have the maximum positive impact on broadcasters and DTH operators and a negative impact on LCOs. Increasing focus on regional advertising and strong growth in HD panel sales, which means broadcasters will have to redefine their content mix and delivery. As you can see, digitization will completely revolutionize the current value chain with the share of broadcasters to amplify.
Now let's have a look at the great business of Z. Z, founded by Mr. Subhash Chandra in 1992, is at present an industry first mover and a thought leader. It is the largest listed broadcaster and is continuously entering into the new segments in order to fuel its future growth. As seen, it generates 2/3 of its revenue from India. The revenue and the PAT have grown at a rate of 15% and 14% respectively in the past 5 years. The timeline clearly shows that Z has taken both inorganic and organic growth in order to enter the international, regional and the sports business. Z basically has a portfolio of 32 channels which can be divided into the 5 genres as shown. If we do a qualitative analysis with respect to its peers which are both listed and unlisted, it can be seen that Z has a good brand and distribution reach. If we do a channel portfolio comparison, it clearly depicts that Z has a good diverse mix. If we come to the value creation model, it generates 53% of its revenue from advertisement, 44% from subscription and half of it goes for the operating expenses, leaving an EBITDA margin of 26% for the company. We find the management quality of the company average, and if we rate CSR on the given 5 parameters, it is found to be good.
We expect strong revenue growth for Z, primarily driven by increasing ARPU and the reporting due to digitization, and the margin growth for the Z is not expected to keep a pace with the revenue growth due to increase in the content cost. Our analysis yields that going ahead, ROE will peak at 27.6% in FY13, and as per our discussion with management, company is not planning to take any debt in the short to medium term. Hence, the ROE will be majorly driven by increase in asset turnover and the PAT margins. Robust working capital management and the steady return ratio will aid in the financing its future expected growth. Now, on a global front, Z is well positioned not only in terms of revenue and PAT growth, but also in terms of return ratios and profitability. Economic value added by the business has been distributed to shareholders not only in terms of a stable dividend payout ratio, but also exceptional capital appreciation since IPO, and the management decision to roll out the 120 crores as a dividend to the preference shares indicates the company's ability to generate the future cash flow efficiently.
Now we'll see why we say that it has stretched valuations. So first of all, we'll focus on why digitization has been a bumpy ride in India since May 2002 for the government as well as all the other stakeholders. The first digitization bill in India was passed in May 2002 with the CAS bill. This bill aimed at digitizing metros at the end of 2003. However, the government had to denotify CAS in 2004 due to political pressure and operational hurdles. In 2005, again TRA suggested to have digitization, and in 2008 it set up a target of completely digitizing India in the next 5 years. However, still today we are at around 55 to 60% digitization. Even on a global level, when we even over here, when we see the stock price of Z has been very enthusiastic to various government initiatives for digitization, but investors have always met with disappointment with denotifications going ahead. Even on a global level, when we compare countries like China, Japan, Korea and USA for achieving 20% and 50% digitization levels, India has been on the higher side of achieving that level. For example, the average time to achieve 50% digitization in India has been around 8 years, has been around 10 years. So we expect it would be very optimistic for us to assume that we'll be able to achieve 100% digitization by 2015. In our view, it will take around 6 years from today to achieve 100% digitization. However, the state has already factored in this outperformance, and we can clearly see that this has been driven mainly by PE expansion and not by the fundamentals of the company. Now over here, what we see is the market has discounted Z at a cost of equity of 10.7%, which is equivalent to some of the pharmaceutical companies and FMCG companies which have a very stable cash flow. For Z, the cash flow is not stable and it is uncertain depending on the digitization timelines. Hence, we see this as a very optimistic case taken by the street. Even on a global growth adjusted basis, what we found was Z is the most expensive media company based on EV by EBITDA as well as PE multiples. Some of the other concerns that we have with the company are the ad growth for the company might slow down given the persistent slowdown in the economy.